Good morning to you guys. Thanks for being here with us today. Good morning to our viewers. You are with Loan Officers of America Network, Mortgage Titans edition, and we've got a special panel with us today to talk about the 2021 outlook. We've got industry voice and CEO of MBS Highway, Mr. Habib, with us today. CEO of Geneva Financial, Aaron VanTrojen. And we've got everyone's favorite morning show host, Frank Garay, and Brian Stevens, otherwise known as Frank and Brian from National Real Estate Post. I am your host, James Polinori, co-founder and president of Loan Officers of America Network. All right, guys, let's get right to it. Barry, the question on everybody's mind right now, what are rates going to do in 2021?
I know a lot of people forecasting rates to go up next year. People thinking that rates are going to go much higher. You get a Fed meeting next week. And one of the things I'd be on the lookout for is some talks about whether they're going to buy longer dated maturities. If you think about what's going on in Europe right now, the ECB just went in for 500 billion. Think about what the yields are there. The German Bund right now is negative 60 basis points. Think about this. In the world, there is an absolute record of $18 trillion that are negatively yielding securities. Negatively yielding, 18 trillion. So why would somebody invest in a bond that, okay, here's my money, I'm investing, here's my money, and oh, okay, every month I'll send you money for that? Why would somebody do that? Because the thought process is that yields will go lower still, and then you actually make capital appreciation, you make a lot of money. People in the bond market this year made about 25%. You say, how could people make 25% on treasuries when treasuries are yielding less than 1%? You make that because when you invested above 1%, when it went down to 50 basis points, you made a lot of money. I mean, these are the type of things we teach in certified mortgage advisor courses. So this is what the world is thinking. When our Treasury Secretary was Steven Mnuchin, Treasury Secretary signs all the money, right? All the dollars you have in your pocket, there's signatures on it. It's shifting to Janet Yellen. Now, Janet Yellen was not a good Fed chair. She was pretty bad. She's going to be an even worse Treasury Secretary. She never met a spending plan she didn't fall in love with. I mean, she is a shopaholic, but except her purse is pretty heavy. She's got a big checkbook. Steven Mnuchin used to butt heads with Jerome Powell. Jerome Powell thinks the Fed should do everything. And when you think about it, he went a bit overboard. Is there any reason why the Fed had to be buying bonds of Apple? Is Apple struggling that bad? Have you seen their stock price? But Jerome Powell thinks that the Fed should be, wet nursing everyone. Steven Mnuchin kept him in check. Under Janet Yellen, she will be his biggest. She said, "You're not doing enough." So it'll be interesting in 2021. I think that the Fed will be doing a lot more purchases. I think that the Fed will buy a lot more longer dated maturities. I think inflation remains low. The debt in our country is $29 trillion after the stimulus plan, which will slow growth. We're not printing money, so that debt has to be serviced. I think that there's going to be a lot of pressure on rates to stay low. Now, this doesn't mean that they don't move. There's going to be periods of time when they'll go up. Look, twice when the Fed was at zero between 2009 and 2016, mortgage rates went up by over 1% during about a 4-month period in 2 different occasions. Doesn't mean we can't have periods where they go up, but by and large, you're going to be in a very good low interest rate environment. Housing market's going to be insanely strong, and refinances should be plentiful, but there's so much equity out there that you need to be an expert on debt consolidation.
Interesting. If you were a gambling man, what's the lowest you think we'll see rates go in 2021?
They make rates on the 10-year or rates on mortgage rates?
Mortgage rates.
I think there's a chance that they challenge the all-time low rates that we've seen at periods of time. There is a good chance that they do that. They may peak above 3% and maybe 3.25% for periods of time. And 3.25% is important because that would wipe out for a period of time interest in people wanting to do refinances by about 50%. So that's a very important threshold. But I think that could we get in the neighborhood of 2.5% on mortgage rates, dependent on capacity within the industry, which does preclude rates sometimes from moving even lower. I think that there's a chance of that, yeah.
Okay.
Oh, by the way, Fed's already buying 1.5 coupon bonds. So they're already setting the stage.
Another question that with registration, the attendees answer or ask questions of the panel. And one of the main ones that came across was, what do you think a change in the administration will do for our industry? And Frank, I'd like you to start with that. And then maybe Brian, if you want to follow up with that.
Yeah, no problem. I think the one of the biggest concerns we have with the administration change is going to be the CFPB, of course, and compliance. I think compliance is going to get looked at a whole lot harder. I think on their agenda, uh, uh, they take office, number one for them is, let's fix COVID, right? And then number two is let's fix the CFPB. And I think Biden's already suggesting bringing corduroy back. Whether that could actually happen or not remains to be seen if this all goes down. But that's kind of the direction that he's leaning. And so I think compliance is going to be the big deal for one of the big deals for us going forward with if it's a Biden administration, if that's the way it actually does pan out. And I know that I might not get liked for saying this, but one of my concerns within the realm of compliance under a new administration is the broker channel. And I'm a fan of the broker channel, big fan of it. Was a broker my entire career for the most part when I was originating. But we remember from 2008, 2007, 2008, the stereotype came out that the problem was what? Mortgage broker, which wasn't the case. Mortgage brokers never invented a loan program, never have underwritten a loan program, have never funded a loan program. They were not the cause, but they, unfortunately got, marked out as they're the problem. So I think up on the Hill, there might be still a lot of that in their minds where they're thinking broker equals bad, which is unfortunate. Maybe not, maybe it's been long enough, but my concern would be is that the CFPB crosshairs definitely are going to come on compliance in general for all mortgage companies. I know that that's going to happen, but there may be some focus on the broker channel a little bit, which, and it might not be any big deal. These days, the way compliance works with the broker channel is it's pretty much the wholesale lenders are handling a big piece of that puzzle, a big chunk of that pie. But I would just say if as a mortgage banker or as a mortgage broker, just start taking another look at your compliance, making sure you're tidy right now. Look a little deeper into it because we have been a little relaxed there. And if you're in the broker side, again, just make sure you got your ducks in a row. Just make sure everything looks as compliant as you feel it is supposed to be, right here and now. So, I mean, that would be my 2 cents on what to look out for. One of the things anyway.
Very good. Frank, Brian, do you have any thoughts on that?
Yeah, well, I mean, I think there's a couple of big things. First of all, to dovetail off of what Frank said, the incoming administration could go ahead and fire the director of the CFPB without cause. So they can go ahead, and Biden's absolutely going to come in the first week and replace Kathy Kraninger, and they're going to bring somebody who's much more of a hawk like Corduroy was. Corduroy, his name has been bantered around, one of his lieutenants. Elizabeth Warren has been coming out the last couple of days, especially on Twitter, making recommendations for the new head of the CFPB. And it's going to be a different compliance world. There's a big belief up on the Hill right now that the past 4 years under Trump has been too loose, and that the mortgage industry is running fast and loose right now. So there's going to be a concerted effort to come back into the mortgage space and try to find many more punitive actions. It's no surprise right now that everybody who has an outstanding case with the CFPB is trying to settle it before January 20th, because they feel they can get better terms on these settlements now than after the Biden administration, if in fact they do come in. So that is going to be a big concern. I think everyone is going to have to start to look at their compliance. On the other hand, with the FHFA, I think that's kind of a big one as well. The Supreme Court just a couple of days ago hinted that what's his face, Mark Calabria, is going to be able to keep his job over there. So the whole idea of recapping and releasing Fannie and Freddie from conservatorship, which is what the Trump administration has been trying to do for the past 4 years, doesn't look like he's going to be able to hit that time frame unless he does get 4 more years. And again, this isn't political one way or the other, but the incoming administration has absolutely no desire whatsoever to take Fannie and Freddie out of conservatorship. So I think what we're going to see is more business as usual. Now, I think it's a double-edged sword there. Keeping them in conservatorship is going to probably help keep rates a little bit lower. because under conservatorship, we have an explicit guarantee, not an implicit one, but an explicit guarantee from the GSEs, meaning they have much more clearly defined roles in terms of what they're guaranteeing over there. And so I think for the mortgage space, it's going to make us a little bit more comfortable. It'll probably keep rates down a little bit, but coming out of conservatorship, if Biden comes in, I just don't think it's going to happen. And I think for the overall health of the mortgage market, they do have to come out. You know, the GSEs, it is the longest conservatorship in the history of this country. And the whole idea of conservatorship is to simply right the ship of the companies and then release them from said conservatorship. I think the reason we haven't done it, and everybody sees this, no one's talking about it, but it's a cash cow for the Treasury. They're making an enormous amount of money. They're no longer doing their complete sweeps. They're allowing the GSEs to recapitalize, but the amount of money that they need to bring in simply is not going to happen before January 20th.
Very good. Maria DeVito, one of our viewers, would like to know if you foresee an onset of short sales and or foreclosures next year. Frank, that one is for you.
Actually, I'll jump on that if I could real quick.
Yeah, I was going to say Brian's all over this. He loves this particular topic in general, I know. So I would never want to steal his thunder on this one.
Well,
Take it
you know,
away.
we have a lot of people that are coming out of forbearance right now, which on the surface looks really good. But at the same time, what we're seeing an increase in people who are 60, 90, and 120 days late. So people coming out of conservatorship, we're not seeing many people going back into conservatorship. So of course, those numbers are going to go down. But the devil's in the details.
Forbearance, right? Is that what you mean?
Beyond our forbearances are going down. But when you see those who are 90 days and 120 days late on their mortgage right now, and those numbers have tripled over the past 6 months, that should concern everybody. But, you know, to Barry's point, everybody's sitting on so much equity right now. There's no reason to short sell a house. If you find yourself underwater, you can simply sell that house, you know, keep the profits and live to fight another day. I think the wild card in this whole thing, everybody knows, is COVID. You know, out here in California right now, we've got everybody locked down again. Businesses are going absolutely insane, and there doesn't seem to be any reasonable relief, on the horizons. As we sit here today, there's 800 small businesses that are going under every single day. According to the latest report that I read, 110,000 small businesses have been scuttled since this whole coronavirus thing began. And when we look at the rest of the country following the lead of New York and following the lead of California and possibly having more strict lockdowns, those numbers can increase. And I think that's a wild card because, listen, these are people who employ people, bring money in. How many people are we actually putting out of work who can't make their payments, who don't have any reasonable relief on the horizons? So we could see sales increase. I don't know if we're going to see short sales because, again, in every major metropolitan area, property values are higher than what they were in 2008. So if you bought a house over the past 5 or 6 years, you're sitting on equity. So the short sale or foreclosure probably not going to happen. Could we see more inventory of existing homes come on the market? Hopefully. And again, is that necessarily a bad thing? Because right now we have an inventory shortage. And so if we got more properties to come on the market, there is massive, massive demand for these houses. So I don't think it's going to affect the housing market. I think we're going to be able to stabilize where our prices are at right now. I think that we do have some questions that need to be answered, but foreclosures and short sales, I don't think it's going to come to that.
Very good. Dennis Likens, another viewer, is asking for perspective on why we have a 1.5% MBS. Barry, what is your take on that?
An appetite for it, and the Fed's buying it. You have all different coupons. You have a 1% MBS coupon as well that can be issued, but right at the present time, there's not an appetite for it. So the question isn't really why. It's just, why would you sell anything for a certain price? The market is demanding it. Yields are heading lower, and that's what I was talking about. The Fed is buying 1.5% coupons. They're setting the stage for pushing rates down even further.
Very good. Aaron Scott had asked what most substantial change loan officers will need to make next year and in the coming years to adjust to everything that we've gone through this year, and it's caused a lot of change. Aaron, what advice would you give loan officers that are asking themselves this questions? How am I going to adjust my business moving forward?
Well, let me, maybe this will segue into that question, but I want to touch on about the changes in the Biden administration, because One thing that I never understood with this industry is that, you know, we're constantly fighting change. We're constantly fighting regulatory change. They have very short-term memories about what has happened, where we're at today, and what's happened in the past. And I started my company in late 2007, 2008, during the time of the mortgage meltdown. And for anybody that's on this call or hears this, that was in this industry, realizes that was a very, very traumatic time in our industry. I mean, it took out hundreds and hundreds and hundreds of companies, and tens of thousands, maybe even hundreds of thousands of loan officers were wiped out, foreclosures and everything. And that was predominantly due to the lack of regulation in our industry. It was a cause of deregulation. It was the cause of no regulation and no oversight. And what I remind people of is the reason why 2020 was booming. The mortgage industry is booming. The Great Recession this year had nothing to do with the mortgage industry. In fact, we had a lot to do with actually pulling this country out of recession, was due to regulation. It wasn't a bad thing. It prevented us from doing all the terrible loans that we'd done prior to 2008 that led up to the greatest, recession in U.S. history. So why is it necessarily a bad thing? Yes, it can be overreaching, and sometimes it can be a little painful because the pendulum swung completely the opposite way with Dodd-Frank. But it doesn't mean the things that were put into place by Dodd-Frank were all bad. Loan officer compensation, yes, somewhat painful, but it also prevented people from taking advantage of elderly, Hispanics, minorities and women and the whole thing. That prevented it. It largely squashed it. It prevented that from happening. It prevented us from doing the stated income loans and, fog a mirror and we'll give you money. It prevented all that, which I think most of this industry is pro. I think most of our industry doesn't want that to be a part of our industry anymore. That was a product of regulation. And for the last 4 years, it wasn't that the administration rolled back all those regulations. Most loan officers couldn't tell me a single policy that changed that affected this mortgage industry in the last 4 years, because they largely didn't. The difference is there was no enforcement. The CFPB has sat on their hands. Now, I'm largely responsible for the recruiting of this company. So I talk to half dozen of loan officers every single day of the week for years and years and years. So I have a very, very wide radar on what's going on in the industry. And I cannot tell you a single loan officer or branch or even company owner for that matter that I would say is abiding by the laws at all. Why? Because one, they largely don't know what they are to begin with, which is painful. But the second part of it is that there's nobody to enforce them. Nobody's going to jail for doing things. I mean, no mortgage companies, and not to attack the brokers, because like Frank said, is that I was a broker most of my career. I'm a huge, huge supporter of the broker channel, even today. Is that the brokers largely don't know what the laws are and they're largely not following them. Why? Because what do they have to lose? Most brokers have to have a net worth of $60,000 so they can do every loan under the sun out of compliance. And what's their risk? $60,000. So I think that first and foremost, we need to alter some of the laws. There's without question, we need to be more rational on some of the regulatory things that affect this industry, but we need to enforce those things. So, and this kind of swings to the other part of your question. What do loan officers need to do? Get smart. Know your industry, because most loan officers don't. And I don't want to sound too harsh, but they largely don't. I mean, how many times I get on the phone with a loan officer or branch manager who says, Aaron, that's your interpretation of the law. And I'm like, well, have you read it? Nope, they haven't read it. They have no interpretation of the law other than what they've been told by other people or read on Facebook posts or whatever. That is a terrible place for our industry to be. For somebody that can make so much money. I mean, I can't tell you how many loan officers we have in our companies that are in our company that are 7 figures this year. Loan officers, not branch managers, 7-figure loan officers. When you're making $1 million plus a year, you should know everything there is to know about your industry, including the laws that regulate it. So I think that the industry is definitely going to change. In 1 year, is it going to change very much? No. I mean, there's going to be a regulatory aspect, and people should pay attention because loan officers don't realize that that NMLS number is a timestamp on every loan that you do. And because you're a licensed loan officer, you're as equally as responsible as your company for violating the laws that you might be violating. And under an administration that cares about enforcing laws, they might go to work on you. We have a $30 trillion deficit that needs to get paid back. What a way to start paying it back, but to dip it into the pockets of all the mortgage companies and loan officers that have been violating the laws for the last 4 years. That's where I would start, because it's easy. Anyway, I get a little riled up on the situation because, one, I'm just beside myself at the lack of knowledge about the regulation people bitch about and know nothing about. And also to not realize that a lot of the regulation is why we are booming in 2020. We are booming. And under Obama, 2008 through his entire career, the mortgage industry did outstanding. I had some of the best years of my career during that administration, under all that terrible regulation that forced all my loan officers to make more money than they ever had before. So, I mean, get over yourself. My loan officers are making more per transaction by law. By law, they're forced to make more money per transaction by law than they've ever had in their previous career. Why are we complaining about that? Doesn't make sense to me. Follow the laws and you might make more money.
Well, and that falls
Awesome.
in the space of
Awesome.
that falls in the space of consumer confidence as well. They pay attention. I mean, as real estate agents will tell you, they're noticing that more consumers are going to find a loan officer first now, and that cycle has been happening. And over the past 18 months, we're seeing on the marketing side, which is what I study most, is that trend of social media has educated the consumer that they need to be pre-qualified before they buy a home, and so they pay attention and they know those regulations protect them. So I think it benefits, especially on the marketing side, it benefits the loan officers and the real estate agents to have those regulations in place, because you have more confident consumers and they're going to be willing to work with you. But that kind of leads into the next question of moving forward, because as you said, Aaron, 2020 is not going to change everything in 1 year, but it's certainly, to me, in a lot of aspects, is looking like a catalyst. You're going to still have a lot of people after this experience that maybe want a 100% digital experience. They don't want to meet with people that they don't have to because they don't know what's coming around the corner. You're going to have a solid percentage of people that don't want to meet. So technology wise, that was one of the questions that several people brought up. And Courtney Hall is the one that had the most prolific question on this. And she wanted to know how we see technology in the mortgage industry changing in 2021 based on what has occurred, not just this year, but the trend that we've been on as an industry over the past 5 years, and for the foreseeable future. How is this landscape going to change? And Frank and Brian, where do you see industry or technology playing in our industry after this year?
I'll start and then Brian can take off. But I think what we're going to see is, and we have, like you said, we have been seeing is, I think we're going to see more and more mortgage companies doing consumer direct because it's just becoming so easy to do. In all honesty, I do sell real estate now very, very part-time with my wife. Like if something falls out of the sky, we'll work it, friends, family, something like that. We're not out there trying to do anything, but just to kind of illustrate this, I'm here in Vacaville, California. My son is a mortgage broker out here in Vacaville, California. So if my wife and I get a real estate deal, do you think we're probably going to say, hey man, you need a loan, why don't you talk to our kid? Of course we are. Of course we're going to do something like that. But we just closed a transaction that we've been kind of working for the past few months where these borrowers wound up in our lap. I came off of a LinkedIn or something. They wound up in our lap, but they wound up in our lap with a pre-approval letter already. They already had a pre-approval letter. That loan originator worked in Arizona, and we're out here in Northern California. And yes, Aaron. And but the thing is just so you know, I mean, my experience is, would I rather have my kid get the deal, or let's not even call it my kid, my local lender have that deal? Well, sure, probably, but I mean, I didn't blink an eye at it. I was like, you got a pre-approval letter? You're pre-approved. I had a quick conversation with the originator. He said they're good to go. What am I going to do? I was like, fine, let's go do the deal. You know what? Close just fine. Close just fine. So it's becoming very, very commonplace for a transaction to take place with an originator or loan company who's not even in the same state, handling that transaction, in a completely different state. And I think that, and I know as originators, we do like to work with our local real estate partners, and there's definite benefit in that. And we should be doing that. We should always do that. But I do believe that even on the real estate side, I think real estate agents are becoming more and more accustomed to or used to, possibly working with an originator that's not in their backyard, because the originator found the borrower first, or the borrower found the originator somehow. So I think this, there's two things to look at here. And that is, as a mortgage company, so many of them right now are going consumer direct. So many of them are finding ways to go consumer direct, which I think is very intelligent, very smart thing to do. I think originators themselves, even if your company's not doing that, you need to find ways and find technologies that can help you go consumer direct. And I think that originators who are working well with their local real estate community need to understand that you're not always going to get the deal now these days, right? Even if you've got a very faithful real estate agent who's happily will send you a transaction if they can, they aren't necessarily going to rock a boat, on a deal where the borrower's already started something, been pre-approved somewhere else. They're not necessarily going to say, stop everything, don't use them, talk to my guy. That's not necessarily going to happen. So with that in mind, I would say this, because another thing that Brian and I have seen very recently that is just astounding to us is when as originators now, when we start getting a purchase lead in, however we get it, referral, whatever that case may be, it is more imperative than ever that you jump on that dang lead like a vulture on a dead deer, and you don't stop working that lead until you have some sort of feedback on that, if possible. Because I think the deals, since it's so easy now for a mortgage company or mortgage originator to go to consumer direct and pull something, out of the air to originate, that each lead is going to become more and more valuable to you, and more important for you to work. It's me and Brian, I know we've got some people watching us here. We're talking the other day, we're like, dang, because we're working directly with some, a bunch of loan officers, and we're handing off leads with the stuff that we do. We do a lot, with our listing booster product, et cetera. And sometimes I go, man, sometimes I think the biggest problem with the mortgage industry is the loan officer. You know what I mean? It's like, sometimes it just is, it's maybe not a nice thing to say, and it's, kind of just a pun, but sometimes it is, I think right now we're just so, we're doing really well, as a whole, as an industry. There's a lot of refinance activity out there. I just, when things change, and they will, and we've all been saying this, everybody's saying it, better be really good at converting what you get, better be really good at working at what you get. And I think it's really important to look at technology. To answer your question, I'll hand it to Brian. Look at technologies that are going to help you as an originator or as a company. Definitely go consumer direct, because especially with the pandemic, I mean, everybody's used to this, right? Everybody does this today. Everybody's on a Zoom today. How many clients can you, I mean, I can handle a client anywhere in the country, because I can say, hi, this is Frank. How are you? Let's have a conversation. It's easy to do now. We don't have to be in each other's backyards to do a mortgage. We just simply don't. So I hope that answered the question. I'll hand it off to Brian.
Brian?
So since the pandemic hit, 1 out of 3 people is either partially or fully working remotely. That's a huge number. It's staggering. You're finding some of the high cost metropolitan areas in California and New York, and people are moving. The states people are moving to right now are Texas, Florida, and New Jersey, ironically enough. I think New Jersey, because people are moving out of New York, and New Jersey's, it's a close enough destination. I think people are going down to Texas and Florida because they're business and tax friendly in general. What this pandemic has done is it's just sped up what was the inevitable. People want to work remotely and people want to shop for mortgages remotely. People want to shop for real estate remotely because it's easier than jumping in a car or going down to somebody's, brick and mortar office. So this is absolutely inevitable. I think we're going to continue to see this trend post-pandemic continue because people are becoming accustomed to using technologies like Zoom. Everybody's accustomed to using, mobile mortgage apps right now. Most of the loan officers I talk to don't meet with their clients and have not done so before this pandemic. It's bringing the real estate community on board right now, and I think after the pandemic, this is going to be the standard. But when you look at some of these high-cost, high-tax areas, I think you're going to continue to see more companies leave. Hewlett Packard, who started the Silicon Valley, they were the bedrock, the cornerstone of the Silicon Valley. They've moved their headquarters to Austin, Texas. Goldman Sachs is down in South Florida right now, looking to move part of their operations down there. I think it's $7 billion of their operations, taking it out of New York, and they're doing it for obvious reasons. The tax burdens are difficult, and people don't necessarily want to live in, our big cities right now. I think that trend's going to continue. People are moving to places that are going to be more tax friendly, more business friendly, and less expensive because working remotely is going to become the new standard going forward. So I think continuing to see this migration away from our metropolitan areas out to the suburbs or even to other states will continue. For loan officers right now, I think a great thing to do would be get licensed in other states, particularly the states that are the destinations, which is New Jersey, Florida, and Texas. We have a list of every loan officer in the country, all their production, who they work for, where they close their loans, and the realtors who they closed them with on their purchase deals. So we were looking at Solano County where we live right now, and we've got probably a population density of about 400,000 people in Solano County. And with one eye shut, as Frank and I were going through this, I would imagine that 70% of all the loans that we looked at were done from loan officers that were outside of Solano County. So Solano County loan officers, and we're saturated with them, only picking up about 30% of the business. Now, of course, this has a lot to do with the refinance market that we're in right now, and people are mass mailing, and you're going to get some of your big box lenders who are going to take a lot of that business. But that's a pretty shocking number. People are accustomed right now to working online. Our clients are, our realtors are, our lenders are. This is a trend that's not going to reverse after COVID, disappears, God willing, in the next 6 months or so. So I think right now getting licensed in other states, making sure that you have mobile mortgage application is absolutely huge, and embracing the changes that are in front of us, because technology used to be its own standalone industry. You had the service industry, you had the travel industry, and you had technology as a standalone industry. Over the past 20 years, technology is no longer a standalone industry. It permeates every other industry in the country, and it's only going to speed up. This is the new norm. The pandemic has simply sped up what was inevitable. And listen, the big box lenders, for the loan officer, the big box lenders, of course, are going to take a lot of business. And of course, you can't keep up with the Quickens of the world with their technology, but they have a macro business approach. You need to take a micro business approach. And there's enough tools available out there for a loan officer to go out and carve out their own personal success, even in a changing market. But it's imperative that you jump on board.
It is. And I want to piggyback off of that. What Frank, you were talking about, consumer direct. When I coach loan officers, I call it consumer forward. And it's just a mode of thinking of getting in front of the consumer first. And being proactive in that space. And Brian, you're right, it's not going to change. It's a catalyst. It's going to accelerate now because of COVID. And people are realizing, Zoom isn't so bad. I kind of dig working at home in my pajamas. I kind of dig, refinancing my home straight from my computer while I'm working at home and handling all of these things. So I do think that's going to accelerate. And if your company's not providing you the tools that, my opinion, and Aaron knows this strongly, is that the company should be helping the loan officers mine their data and putting alerts in place for refinance opportunities and watching these things. And the consumer direct you're talking about, if there's not automation in place, just like the buzzer getting on the dead horse there, you're going to miss the boat if you don't have automation in place. Because you can, loan officers come to me all the time. Where's the best place to buy leads? I want to buy leads. And my first question to them is, what's your follow-up? What are you going to do with those leads? And then, they want to buy ones that they're getting live leads as they come in from forms on Zillow or Realtor.com or wherever they're getting them from, but they're not connected to anything. They're not doing anything, or they'll connect them to another system. They're not calling. And so, I think personally that a lot of companies are going to have a rude awakening in the marketing space of having to pick up the slack and do it for their loan officers and educate their loan officers on what's happening in the background so that they can be successful with it. Because if you count on your loan officers to do it individually, then you're constantly going to be in this state of you have your top producers, your handful, and then you got everybody else always struggling and then taking up everybody's time. Coach me, teach me. I want to buy leads. I want to do this. And they never have success. If you put things in place, I always put automation in place, and refinance was massive this year because of what I put in place. And those communications were going out. The loan officers had no clue, and they're getting responses back like, holy crap. And it's because the automation knew that they were primed for refinance, or if they're on a purchase, it's coming directly in to their client data platform. It's sending a text message immediately. That's not new technology, but there's other pieces that are melded into it for automation that the loan officer can basically just say, I want to invest, here you go. I need to go consumer forward, and they can focus on other things. My other point with that technology is I think the biggest fear factor people have is a disconnect from their clients because they feel that their business has been built by relationships and they're worried about that. But, my coaching to them is always that technology is giving you more time for those relationships. And the profile of consumer right now is they want to research online. They want to research on an app. They want to do all of those things on an app. But when they have questions, they want a human holding their hand. And this gives loan officers the opportunity to be that human and be more involved, more educated, instead of spinning their wheels, constantly taking the little questions that technology could have handled. So I think that I hope that this industry embraces it further, continues down the path, because this industry has been horrible in the marketing space until recently. And I hope that we continue that path forward of being marketing forward, because we now have to be. The consumers are looking for loan officers. So let's talk about product. A lot of question about product. Non-QM, you guys knew it was going to come up. Who wants to take the non-QM question? Where do we see that in 2021? Is it going to die a slow death, or is it going to come back strong? Who wants to take that?
I'll chime in real quickly. It's going to come back strong and do great. It already is bouncing back in a strong way. We work closely with Oak Tree Funding, and we're, have our finger on the pulse of product changes and things like that. They're getting new products all the time right now. They're securitizing again. Their product mix is changing to make it a little easier for consumers, a little easier on the FICO, a little easier on the LTV, that type of a thing. It's already happening right now. The good news about non-QM2 is it's an incredibly important and very needed product out there. This is not subprime. This is not fog and mirror at all. There's ability to repay built into these products. Jumbo financing is critical. They tend to lead the way on jumbo quite a lot of the time. It's based on borrower profiles that tend to need those products as well. So, long and short of it for me, I think you're going to see non-QM explode and just do better and better as we go forward.
Brian, do you have any thoughts on that?
I'd actually like to hear what Aaron thinks about non-QM.
We were kind of ahead of our time on non-QM. We'd been banking, not brokering, banking non-QM for about 5 years. We were, I think, Angel Oak's first correspondent lender in the country. And So we were kind of ahead of the curve on it. I'm bullish on it. I think it's a great product. I think in many cases, non-QM is far more safe product than FHA or even government or agency loans. It's rational. It makes sense. You have to verify things, and they usually keep DTIs lower, and you have equity in the deal, right? So that's really, really important things. In fact, two of the biggest factors when it comes to a loan not going into foreclosure is equity and the ability to repay. And I could argue that a lot of FHA loans are done right now with, just barely the ability to repay. But the problem with the fiasco that we just went through is why we were really, really bullish on it and did a tremendous amount of volume for the size of our company, is that when things went sideways, the non-QM investors that were banking and securitized it largely screwed us. They screwed us because they lost their funding overnight, and all these loans that they had, kissed approvals on to purchase from us, they didn't. So we still service millions of dollars of non-QM loans that our correspondent said, yes, this is a good loan. We'll do that loan. We'll buy that loan. And then, oh, sorry, Aaron, psych, we're just kidding. We had a little bit of an economic problem. So the problem with non-QM lenders versus Fannie and Freddie aren't going to do that because the implicit guarantee of the government, which is really, really important in mortgage lending. You want the government to bail you out if there's a problem, especially if it's a problem that you had nothing to do with. Non-QM lenders are going to leave you high and dry. In the broker community, again, doesn't really matter because they're brokering. They don't have any skin in the game. On the banking side, we'll get really bullish again because I love the product and I think it's great for the industry. I think it's great for most consumers, but we're a little bit gun shy of just diving back in the way we were post pandemic because we got our ass handed to us by some of the biggest mortgage players in the industry, and you guys all know their names.
Maybe you should have been brokering those loans.
I don't believe in brokering for us. And again, I think that you should have skin in the game on every transaction. It's also typically better for the consumer. You have control over the product. And I don't want to broker loans. It's not my model. So I anticipate that January, February, we'll start rolling back non-QM products. And I think we're going to just pick the players that we use better. And I thought we did because they were the biggest names in the non-QM space, but didn't work out so well.
We'll send you a name and a number after this.
I want to see their balance sheet.
No problem.
Yeah, non-QM, the product is necessary. There's a demand for it. It absolutely has a place. It is being underwritten responsibly. To Aaron's point, is it more volatile, than our GSEs or Fannie or Ginnie? Of course it is. But I mean, this is the industry we chose, and we got to lie in the bed that we made, right? So,
yeah. Well, I want to dig a little bit deeper on that. There were several questions that covered product, and another one I thought it was a really good question about self-employed borrowers, and typically they've just got the bank statement loans and maybe portfolio if they're higher end to turn to, and the question was regarding do we see any better products coming out in that sector that typically we'll push them non-QM and look at those bank statement loans, but is there anything better for the self-employed borrower? We see a lot more of that consumer.
They're not, as you said, they're not stated income. They're kind of like the old alt doc loans. The rates on these things are fantastic right now. I don't think you're going to get much lower on the LTVs. I think you can find them at 90 right now. I think 90. I mean, you might see a 95, but a 90% on an alt doc deal with the rates as low as they are right now. I mean, they're pretty reasonable. We're seeing more products come online, and certainly there's going to be variations of what currently exists. What we're not going to do is go back to the old model where it's a true stated income deal for self-employed folks. That's not going to happen. I mean, variations, perhaps, some of these non-QM companies trying to get a little bit more competitive on rates. Yeah, but I don't think you're going to see that much of a drop, if anything, really.
I mean, if anything too, didn't they just come out and say now you need 3 months bank statements instead of 2 for self-employed? It's kind of making it even a little tougher.
Yeah, that's with Fannie and Freddie. So, and
That's
they're,
what I mean.
what they're doing
Fannie
is-
Freddie, yeah.
what they're doing is they're trying to mitigate the risk from everything that's taking place with COVID and the uncertainty that we have in our future.
And Aaron, I want to bring this one back to you because I know personally how you feel about this product. There's a lot of questions about having even more down payment assistance programs and things for borrowers that don't fit in the traditional or non-QM space, and having that, you know, that down payment assistance program available. I know that your company does not do very many whatsoever, which is unusual in this space. What is your take on that, and why do you run away
From DPA?
from DPA? Yeah.
We actually do a lot more than I would like. I have been opposed to it. I think that skin in the game is really, really, really important. And I don't think that everybody deserves a house. I don't think it's your God-given right to be able to buy a house. And that's one of the things that the Democrats will definitely do for our industry is they largely think it's a God-given right for you to own a house, and they expand people's ability to buy a house even if they shouldn't. I think that I think that we got to come to our senses as an industry and say, hey, listen, if we're okay with zero down, and I know you hear the counter argument all the time that a VA has been zero down for a long time and they perform very well, but VA, a veteran that got their ass shot in war fighting for the freedom of this country, is different than somebody that works at McDonald's. It's a different deal, right? It's a different person, it's a different borrower, it's a different motivation. But we have to come to the decision: are we gonna sidestep this and piggyback these DPA programs, or why don't we just have 100% program through the federal government, whether it be FHA or Fannie and Freddie, and this get rid of this nonsense with these DPA programs, which again cause most of the time in most situations compensation violations, which again, that's a whole nother conversation about how most companies pay different on DPA loans, which is completely illegal. So it creates another problem. Just let's have a 100% program and have it insured and have it at a higher rate to offset the risk and move forward, or not. But we can't say, hey, we're only going to create, this is coming from government, we're only going to create a loan that goes up to 97% because we need people to have skin in the game. But then allow a third party to come in with 3%. It doesn't make any sense. We got to get more rational in this industry. It's been irrational since I've been in it for 20 years. Why don't we need just some rational decision makings? So do I think that's going to happen in my lifetime? No, I don't think it's going to happen. Maybe if things go great, we'll have a 100% program. And I don't necessarily think that's a good idea. But like I said, if we're going to allow it through DPA programs, then let's just do it.
So what do you say to the loan officer that is hunting constantly for DPA programs and trying to fit people into them?
Why? Unless you think it's your duty in life to provide, people that don't have money the ability to buy a house, which maybe they shouldn't have bought in the first place. I mean, Barry might know about this, or either of you guys. I mean, there's reports, especially over the last few years of first-time home buyers and how happy they are being first-time home buyers. And it's low. It's very, very low. And the reason why, and if you guys all remember the first house that you bought, you were like, yeah, I think I can swing that mortgage payment. You got approved and you went for it. And then you're like, what do you mean there's electricity cable bills? There's maintenance. I got AC bills. I got a roof repair. You get inundated with debts for a house. Home ownership is not for everybody. And first-time homeowners, it's usually a shock to their system, a huge shock. And again, like I said, if you can just Google this, and you'll see endless studies of recent on how happy first-time homebuyers are. They're not. They're not happy. They're not happy.
It's true. I've seen that. I've seen it. I've seen it all over the place where they come back and they say, I don't know if it was really the best idea to do. And then on the 100% stuff, what you're saying, Eric, makes a lot of sense. Like, why don't they just do that? Why don't you just make it a 100% deal? Just if you're going to do that, do it. And then the other thing though, too, is, you know, you do look at the VA stats and they go, well, these don't really default that bad. Well, they've got residual income requirements, you know, so if you're going to do it, why don't you put a residual income requirement so that they can have the money for the PG&E bill and the other bills and all those things. So, you know, maybe you're 100% first time home buyer on this new Fannie product, you know, can't buy a $500,000 house, but they can buy a $300,000 house, but they'll have enough residual income to actually make the payment on the $300,000 house, you know?
So by the way, you might say that a first-time home buyer is not happy when they buy the house as a study. So I'd like to see a study of that person who owns that house 5 years later and they're sitting on $75,000 in equity and find out how unhappy they are then.
Yeah.
You know? Yeah.
True.
It is kind of ironic though when you look at down payment assistance for low to moderate income borrowers, and oftentimes those are the loans where will allow people to push their ratios and they don't have the residual income to fix these things.
Yeah.
I find it ironic that our low to moderate income, our underserved communities are oftentimes put in the riskiest loans as a byproduct of our desire to bring home ownership to more people. And that really can be a recipe for disaster. In truth, we need to be looking at those loans a little bit more closely. And this has always been the case. If you're going to have a mandate to put low and moderate income and underserved communities into homes, you're going to have to push the limitations. And when you push the limitations, you're just putting people in bad situations.
And I mean, we all agree there should be more focus on providing better opportunity for everybody in that space. That's not putting them at risk, and I think that's where you know, those that shy away from it are coming from is their conscience. And I hear from loan officers all the time is you feel like you're squeezing them into a product that, and you worry that's actually not the best thing for them. So I'm very curious as to what happens in that space moving forward. Barry, beyond rate predictions, the other most common question is something that I think everybody in the industry believes they're an expert on, based on you know, comments on a post that they read, and they take that knowledge and then they spread it to somebody else, and everyone thinks they know what's going on with inventory and home values and has an opinion on it. But tell us the truth.
So we've been pretty blessed in the way we've been able to call the housing market. I am seeing so much misinformation out there on affordability. I'm seeing so much misinformation out there on the results of forbearance. I am not at all concerned about the housing. When I understand the housing market, it doesn't mean you're not going to have anyone go into a situation where they have a situation that's not going to be favorable. But overall, the housing market is extraordinarily strong. You have an enormous lack of inventory. And then in the next 4 years, you're going to have, based upon demographics, a huge influx of people that'll be first-time home buyers. It's going to put strain on this. It's hard to build homes because land, regulation, lumber prices doubled. How do you build homes on the lower end and still be profitable? It's not easy. It's not impossible, but it's not easy. In addition to that, when you take a look at vacancies are an all-time low. You know, look, I was pretty much the only guy who called the bottom of the housing market. And while everybody else was talking about how the housing market was going to have trouble, you know, we were calling it right and saying that the housing market was going to be continuing to be strong. And there is no chance that home prices decline next year, regardless of what people think about forbearance, because when you take a look at the amount of people in forbearance, it's minimal. When you come out of forbearance, you're going to be in a position where you don't have a big bill to pay that rides alongside the mortgage. And then when you pay that mortgage off through either a refinance, a sale of the home, or maturity, that's when it's due. So those are going to be staggered, and there'll be plenty of absorption because you just don't have enough inventory on the market, plain and simple. This is going to cause prices to rise. And with regards to affordability, you know, the first mistake people make is they look at the median home price. That is not appreciation. The median home price simply means half the people purchase above, half the people purchase below. In addition to that, when you take a look at the reason why the median home price has gone up 15.5%, it's because there's fewer sales on the lower end, because there's less inventory on the lower end. So it skews that higher. As far as appreciation goes, it's going up 7%. So people will look at, okay, well, wages aren't keeping up when they look at hourly wages. Well, you don't look at hourly wages. I know everybody does, but that's silly because you can make more or less money depending on how many hours you work, regardless of how much you make per hour. Weekly earnings, which is the accurate way to do it, that's up 5.9%. Now, you'll still be a naysayer out there. Okay, 5.9 and 7. You don't use all of your income to make your mortgage payment. You maybe use 25 for now P&I, because you're not going to look at this from a tax perspective. P&I versus your income, maybe it's in the range of 20%. So you can handle a 5% rise in appreciation year over year, and you offset that affordability with a 1% rise in income. Well, income's going up at 5.9% on a weekly basis. This tells us that if interest rates remain stable, you'd be looking at 15, 20, 25% appreciation, and homes would actually be more affordable, not less affordable. This is the 2020 is the 7th best year of affordability. And yet all of this foolishness out there that you see from, you name it, Adam Data, Dan Olick, of course, has been wrong about it for 9 years and going strong. And then you've got all these people like the Crash Brothers and so many more. Even in our industry, there's news publications that you see every single day that's e-newsletters that go out that, just last week, really concerned about affordability. Dan Olick, 2 days ago, says, Frank, you and I talked about this. There's an affordability wall, right? So, the housing market is full steam ahead. And by the way, Frank, the way you handled yourself on that was perfect.
I appreciate it.
You called her out on it because there is no affordability wall. This is an environment where my forecast is for next year to see approximately 6% appreciation in real estate. So when you think about that, if it's a home that goes up 6%, you put 10% down, you made a return of 60% on your money. And yes, you get to live there too. There's not a lot better places that you can put your money right now than purchasing a home. And you have to win that home. And sometimes that means paying full or over asking price. And that's why the tool that we've created of that evaluation of when it would take for your home to catch up to that, it's surprising that it's just normally a couple of months. So if you take a look, many times, if you bid over asking price by March or April of 2021, the home value will exceed the amount you bid over asking price. These are things that we need to be doing. The home environment right now is going to remain strong for a very long time. When you look at the median age of a first-time home buyer, it's 33 years old. You look at births from 33 years ago, puts you in about 1987, let's just say, end of 86 or through 87. The subsequent 4 years, births exploded. So you haven't seen anything yet. Wait for the next 4 years, which is why do all the refinances you could do. That's great. I'm not going to discourage you. But what you really want to do is you want to make sure that you keep a very close focus on the purchase side too, because you're going to be in a really strong environment. And there will be periods of time where refinances will slow down and you're going to be under a lot of tough competition, as Frank and Brian said earlier, from people that, or companies that are now flush with cash. All these special purpose acquisition companies, SPAC, couldn't get that one out. So all those companies and IPOs are flush with cash. And what are they going to do? They're going to put a bunch of headset jockeys there, and they're going to try and write the narrative that this is all about price. It's not about price. It's about making sure that you give the correct strategy, because that's far more valuable. If you were one of these companies, of course you want to push the BS out there that this is the same as buying a flat screen TV, because what they'll say is, oh, look, if you get 3% from me or 3% from them and 3% from them, and if we can beat that price, then we're the best. Well, guess what? While that rate might be the same if you're selling the loan, it's very different how that monthly payment or the dollars used in that or the debts that they have for every single individual family. And that headset jockey is not going to get that. And if you're going to get that, you have to raise your game. You have to raise your level of education. I mean, this is a period of time where you can create generational wealth. So what you have to make the decision right now is, am I going to ride this and when it's over, it's over? Or am I going to use this opportunity to really change the life of my family and the trajectory of my life and my business? Because you have that unique opportunity. You've been given this gift. So in 1955, McDonald's had this banging burger shop, right? They had one store and it was great. So if they were to say, hey, look, this is great, but we're too busy to think about growing it, well, they'd be still a great burger shop, one store in San Bernardino, California. So what is your mentality? That's what I want to know. Is your mentality, you want to be a good burger shop? You want to be a good loan officer and make some money? And hey, good, it's good, it's slow, it's slow. Or do you want to take this opportunity to sharpen your skills, to see the future before it becomes obvious, to try and defend your business and your family against all these predators that are out there that are flush with cash against you, because you can if you do it what's right? And are you going to take the steps necessary to build your business? That's a bullshit excuse to say, I am too busy. If you're too busy, means you're making a shit ton of money. And what you ought to be doing is hiring the people in place. Don't go to your company for it. This is your business. You're the CEO of your business. Get a freaking assistant. Get a junior loan officer. Do social media advertising. Do things like what we have at Social Studio, which, by the way, hot tip to Frank and Brian, who were the pioneers in our industry and taught people to do videos before anybody ever knew about it. These guys were the guys that told you should do it. So if you just listen to what the really smart people are doing out there, they're using social media, they're creating videos, but they're doing it not, hey, use me for my mortgage, for your mortgage. They're doing it with educational information. You can't give what you don't have. How serious are you about being really great? How serious are you about your level of expertise and professionalism? How serious are you? Are you just riding this, or do you want to make this where you create longevity, where every year is a great year, not just 2020?
Every single year.
Hey, Jim, just to, not to interrupt, Brian and Brian, we have that appointment that we were supposed to be on 4 minutes ago. I went ahead and emailed and pushed that back just a couple of minutes, but we've got to wrap up here on our end. And I know, just letting you know, we got to get out of here. So
We're wrapping it up here. Speaking of technology and making time for yourself, using it, Barry, you got a great piece of technology that you've generously agreed to give loan officers of America Network a special rate for. We're going to email that out to the group, and then an introduction to Frank or Brian. Do you guys want to talk about your technology, what you have?
we'll send you a link for our listing booster premium services, if that's okay, and then you can get that out to the people as well.
Just
Yep.
in short, if we can explain it here for a couple of seconds, is listing booster is we basically have created a pre-filtering system where we're generating a higher quality lead. A lot of loan officers right now don't have the time to reach out to the real estate agents or to even call their leads. With our listing booster premium service, we will do your postings for you. We will generate the opportunities. We will call your leads and we'll drop them in your calendar for you. And we're finding remarkable results with this.
Yeah, the thing that's neat about Booster is it's both, you're working both your realtor business and your consumer direct at the same time. That's the very cool thing about Boosters. You work both at the same time. That's how it works. But with that, I got to get out of here. I got a call. I got to jump on. You guys are awesome. Everybody's awesome. I appreciate being here.
And when you're talking about, somebody who's talking about buying leads, I would say, wouldn't it be better to generate your own leads with your real estate agent partners, that they're not being stepped on by other loan officers? And the numbers that we're producing right now are nothing short of extraordinary. Absolutely nothing short of extraordinary. With one of our accounts that we have right now, since Thanksgiving, we generated organically over 100 leads, and we put 33 appointments in loan officers' boxes with just one account. So if you want to learn more about our Listing Booster Premium services, we'd love to talk to you guys.
Thank you, everyone.
Thank you all very
See you, Barry.
much. Till next time.